Hi, welcome to Wise Beyond Bitcoin, your home for the crypto neo news, education, and opportunities, plus the macro updates. My name is Ryan.
My name is Lucas. And follow up on our breaking news macro updates and what's going on in the world economy. Of course, for many people, the world economy is what's going on in the US economy. And that's what this is going to be about. It's about manufacturing indicators, what's going on in the manufacturing markets, and how that will affect rate hikes, and also how have the previous rate hikes actually been affecting the manufacturing market. So we'll get into this relationship and what to expect from the Fed in the future. Of course, this is just educational information. It's just sharing our research and our love for economics and what's going on in the markets. It's not legal advice, commercial advice, financial advice, investment advice. So of course, you go find those vices for yourself and deal with that. This is just a resource to do a little bit of studying. And what did you find? Speaking of a little bit of studying and research, you found this article, and we've talked a little bit about it before the video, but let's get into what is the Chicago PMI and what does it mean?
All right. So yes, this data came out today. This is a look at the volume of or the price rather. It's an index of prices in Chicago related to manufacturing activity. It's a purchasing managers index. So it is essentially a measurement of the cost of the various inputs related to manufacturing inside of the Chicago area. So it's a very small, it's a much smaller sample of data than what data points than what you would get like with the ISM, which is a more nationwide look at the same kind of activity, just on a larger scale. So it's important to understand, because Chicago is a manufacturing hub. So it's kind of these two, Chicago PMI and the broader national measurements of manufacturing, tend to track each other. So it's not a, but it's not a national measurement. That's something to remember. The big takeaway from this data is that it has largely remained unchanged from the month before. I mean, it dipped a tiny amount, I believe 0.1 of a point from July to August. So there is a slight contraction happening, but it's more or less unchanged from the last month. And since the number is above 50, clearly we're still in what they call expansion territory. So it's still a positive, we're still seeing positive growth in manufacturing. But at the same time, it's clear that there is a trend down. So it's not a healthy trend by any stretch. There's definitely weakness in manufacturing. And we're going to get into a little bit about maybe why that is. One thing to say is that that's been a weak part of the economy for the year, for going, since really since the economy opened back up after COVID, the pandemic, that we got back to work, and ever since, manufacturing has really lagged the rest of the economy. We've seen other sectors doing good. Labor market has up till recently been very strong, and personal consumption has been strong. So there's been, and of course, housing has been a notable strength, a strong part of the economy. So there has been strength, but it hasn't really trickled down to manufacturing, and we're seeing that trend is not unchanged.
Well, you mentioned that trend. You can actually see it right there at the end of the chart right there. It's been going down for
Yep.
quite some time. However, being that the news shows we're technically still in an expansion, and it has trickled down a little bit, that, as far as what that means for the Fed and rate hikes and room to continue and what they've said that their overall goal is, are they afraid to slow down the economy in order to curtail inflation? No. And if right now it shows that we're in expansion and they've got room to continue, this is kind of that good news, bad news, or mixed news,
Yes.
bad
Yes.
news. And you mentioned earlier the connection between the PMI ISM. So I'm glad you brought this up, because I believe this article mentions usually the ISM, which is the the national average, that is below the PMI. And right now, where we're at, it shows that the PMI is the Chicago measurement index is actually below the ISM. So as far as these indicators, if you look throughout the chart, usually the national average is below. So what that would mean is that for the national economy on the manufacturing side, that we can expect that to continue to fall down and kind of find that harmony below the PMI. Of course, it looks like the trend for both of them is going to be going lower for some time, especially with the Fed announcing its continued aggressive policy for rate hikes and balance sheet. Now, how are these manufacturing markets being affected by the rate hikes?
Yeah, that's a good question, because that is a product. It's a really big deal. And right before we get into that, I'd like to show that there is a clear difference in how rate hikes and how sectors in how rate hikes impact different sectors of the economy. So we're looking at various indicators right here that go back to the beginning of the year and starting at 100. So we're seeing that most of these indicators are still in the positive zone, right, above where they started. But clearly the green one, which is manufacturing and industrial sales, which is captured in the PMI and the ISM, that's been weak. That's definitely contracting and has contracted since the year started. Whereas looking at income and employment, non-farm employment, personal consumption, and then industrial production, these other indicators are showing that we're in an expansion territory. Yet you could not say that about manufacturing. Clearly, something else is going on in this sector. And so I think your question, to circle back to your question, it's on the nose, because there is a relationship that in manufacturing has with interest rates that the other industries have as well, but not to the same extent. It's been a well-known thing in economics that manufacturing and these real capital-intensive industries, and I'll get into that they're more sensitive to interest rate changes than others, and that they tend to contract when an economy goes into a recession. They tend to be the first industries to contract. They're sort of like a canary in the coal mine, if you will. And the reason is, it's borne out right here, and
there with the chart.
Yep.
In fact,
and it's not just this.
Before you leave this chart,
okay, go ahead.
I was just going to mention, because we just did a video on the job market and how that impacts rate hikes, and you can see here it's mentioning all employees total non-farm, which is what we just covered. Of course, this goes up to July, and we can see that is now starting to fall and drop as well. But yes, the point of that is that the trends, although some of these are still showing expansion or positive, we're really at that top of the roller coaster, so to speak, and getting ready for that, the inflection point, to prepare for a major contraction. Sure. Now, pardon me, go back with explaining why these interest rates have an effect on capital-intensive manufacturing areas of the economy.
That's different than others. Okay, so to get in, first we'll define what capital is, because it has different meanings. It means, in this context, it's talking about equipment, plants, property, the kind of fixed assets, machines, tools that are used to produce other things, and that have a sort of a life. They have a life cycle, right? They have they have multiple seasons or periods or years where they can be used, and they have to be reinvested in, and they depreciate. Go ahead.
For example, if you buy a tractor, your accounting will say, okay, well, we invested this much money and it's going to last for 10 years. And so they account every year a price for the use of that tractor. That's basic accounting. It's basic.
The value of it is like, it's an asset on your books. Every year it gets to be a little less valuable. They depreciate it every year based on the use of the machine, and it's based on interest rates, honestly. So to circle back around, the cost of borrowing money over time, the cost of time is one way to think of it. So because these capital goods have a life, they produce iterations of products that are sold, ever longer into the future. So because of that, and because they're depreciated over time, the changes in those future values based on interest rate changes today have big effects in whether or not that piece of machine is either profitable or a loss. And the more interest rates go up, the more it costs to use the machine, the more depreciation becomes a factor, and the more expensive it is to even invest in this equipment, because these machines are purchased over time, and they get more expensive as people they get bid up by other people who are trying to buy that same machine to do things. So as interest rates go down, the demand for these assets goes up and the price goes up. And as the interest rates go up, the demand for those assets falls and their price falls. And so what that means is that there's not a lot of an incentive to invest in manufacturing in these capital intensive industries when interest rates are going up, because it's going to make them ever more expensive to run and potentially make it where it's not even profitable at all if interest rates go high enough. So this is the reason, this depreciation interest rate channel is the reason why capital intensive industries respond to changes in interest rates more than, say, labor market or labor service sector industries that have a lot of labor involved, because they're not as impacted as much. So that's why you see this chart looking like it is, with this one sector showing weakness where the others are moving sideways.
So they're less attractive for investment, and their cost to operate go up, a double whammy. So you really see the manufacturing take a hit. And like you said, it's a canary in the coal mine to signal kind of where the rest of the economy is headed. And obviously the mixed news that has come out lately from the Fed or from these indicators is that while things are slowing down, technically, according to many measurements, as we see here in this chart, many of the indicators are still showing positive or expansion. And for that reason, continue to expect more aggressive Fed policy and rate hikes, continue to see how those rate hikes will impact manufacturing. We just kind of walk through that there, so you can have an idea on what's going to happen there. And of course, these ripple out like sticky prices. These actions are sticky, and they will impact industrial production, the real
the other
personal
sectors.
Consumption, real personal income, and these other sectors. So if you'd like to stay abreast of this information and know more about how they impact the economy at large, so knowledge is power, and these things ebb and flow. And while we are in a contraction or recessionary time, having an understanding of the actions that are being taken and being prepared for that next bull market when there is an inflection point, a reversal, this is a good time to do your due diligence and learn and research. This is a research educational resource, of course, and we've got playlists to walk you through not just the macro updates that we like to bring, and Ryan brings some great research and perspectives to put it all together, but we also like to talk about crypto projects in general and blockchain as a new technology that's emerging and has the potential to grow at a rate unprecedented compared to other sectors in the economy. And it's still growing. There are still blockchain and crypto protocols that are developing, have developers creating applications, decentralized application, dApps. If you've ever heard of an app on your phone, well, in the future, you may hear of dApps that'll be on your phone, because they actually already exist, and that can happen. And we'll tell you all about it if you like that kind of stuff. Pretty much it.
Yeah, I think that's got it. Like, subscribe, comment, and if nothing else, catch us on the next one. Thank you.
Have a beautiful day, and namaste, y'all.